So suppose you are a Canadian moving to the United States and you own this investment portfolio that you bought years ago for $200,000 and today it's worth 1.2 million. So you've got $1 million of unrealized capital gain. You haven't sold anything, but when you leave Canada, Canada might pretend that you did. And several years later, when you actually sell the investments while living in the United States might want to calculate a gain. At first glance, it looks like you might get taxed twice on the same $1 million. Fortunately, the Canada-USA tax treaty has a rule specifically designed to deal with this situation, but it's not something that you want to find out after you move. I'm Dennis Goossen. I'm a CPA specializing in Canada-USA cross-border tax. Today, I want to explain one of the most important planning issues for Canadians moving to the United States with appreciated investments. I'll try to keep our facts simple for an example. Our taxpayer is a Canadian citizen, not a U.S. citizen, not a green card holder. He owns ordinary investments in a non-registered account. He paid $200,000 for them. They're worth $1.2 million when he moves to the U.S., but he has not sold them. Let's start with Canada. When somebody leaves Canada and ceases being a Canadian tax resident, Canada generally has a departure tax. For certain types of property, Canada treats you as though you sold the property at fair market value immediately before leaving, even though you didn't actually sell it. Shares are one of the common types of property that fall under these deemed disposition rules. So in our example, Canada sees an original cost of $200,000, a fair market value when you leave of $1.2 million, so a capital gains of $1 million. There's a Canadian capital gain in a departure year, even though the taxpayer still owes exactly the same investments. Now suppose our taxpayer moves to the United States. He becomes a U.S. tax resident. From that point forward, the United States generally taxes a resident alien in essentially the same way it taxes a U.S. citizen on worldwide income. Fast forward 5 years, the portfolio is now worth $1.4 million, and he finally sells it. You might assume the USA will say, well, you entered the U.S. with investments worth $1.2 million, so your cost basis is $1.2 million. You've made $200,000 since you arrived, so we'll tax the $200,000. But that's not what happens automatically. Simply becoming a U.S. tax resident does not by itself give all of your property this new fair market value basis. And here's where you get a mismatch. Canada treated the investments as sold at $1.2 million and taxed the pre-move gain. But if the United States is looking at the old historical basis, we could eventually have a U.S. gain that includes that appreciation that Canada already taxed. That's exactly the problem that Article XIII, paragraph 7 of the Canada-U.S. tax treaty is designed to address. The IRS issued Revenue Procedure 2010-19 specifically to explain how someone immigrating from Canada can make this election. For property that is subject to Canadian departure tax, but wasn't already taxable by the United States immediately before the move, the election can give the taxpayer a U.S. adjusted basis equal to the fair market value used for Canada's deemed disposition. Canada's historical cost $200,000, value on departure $1.2 million. Canada taxes the $1 million accrued gains. If the treaty election is properly made, then the United States can treat the property as having a $1.2 million adjusted basis. Then the taxpayer sells for $1.4 million five years later. Now the U.S. gain is essentially only the $200,000 of post-move appreciation rather than that original $1 million all over again, which is a much more logical result. In this case, then, Canada would tax the appreciation that occurred while Canada was the taxpayer's country of residence, and the U.S. taxes the appreciation that occurs when the U.S. is the taxpayer is in the U.S. tax system. The treaty election provides the bridge between these two systems. And don't overlook this. This is not an automatic basis step up that happens when you move. Rev Proc 2010-19 has a specific election procedure. It's made on the first timely filed U.S. federal income tax return after the change of residence, and you have to file Form 8833 to disclose your treaty position. You need documentation establishing the fair market value used under Canada's deemed disposition rules. You need to show that the Canadian gain was properly reported. This is a pre-move, pre-departure planning issue. You want to know the property you own. You want reliable fair market value information. You want the Canadian departure return prepared correctly. You want the U.S. return coordinated with it. And another wrinkle, you could have multiple properties subject to the deemed disposition rules. Rev Proc 2010-19 doesn't let you pick one and make it only for that property. The revenue procedure contains special rules for multiple properties. There's an all properties requirement in situations covered by the election, and the requirement that the deemed dispositions have to have produced a net Canadian gain. So you need to look at the entire departure tax picture. There's some assets that require a completely different analysis. I'm talking about ordinary investments. RRSPs are different. Canadian real estate is different. Business interests are different. Canadian investments that have like mutual funds or ETFs, they're treated much the same, but you need to remember that there's PFIC rules, passive foreign investment company rules, that you need to watch out for. And of course, this is dealing with a Canadian that is not already a U.S. citizen. If you are already a U.S. citizen, living in Canada and moving back to the U.S., the analysis changes because the U.S. has already been taxing you on worldwide income throughout your time. Rev Proc 2010-19 addresses that situation too, but the election works differently in that case. And then state income tax is another separate issue. Some U.S. states do not follow every federal treaty provision, so check the state that you're moving into. The big takeaway is that when you're moving from Canada to the U.S. with appreciated investments, don't just ask about departure tax from Canada. Ask what basis the United States is going to use after you move. Those questions need to be coordinated. This is one of the reasons cross-border tax planning is most useful before you change residency rather than a year or two afterwards. If you're planning a move between Canada and the US and you have investments, retirement accounts, businesses, other significant assets, that's exactly the kind of Canada-US tax planning I work with. You'll find my contact information below, and thanks for watching.